Hello, welcome back. So in today's video, I'll be talking about the only buy and hold forever stocks that you must have in your stock portfolio today. So in today's video, we'll be covering a few things. We'll be covering qualities for buy and hold forever stock, the buy and hold forever stocks that I have on my watch list, as well as some questions that you guys have left me in the comment section below. So what exactly qualifies for buy and hold forever stock? A buy and hold forever stock must have an unbreakable moat. So for a company to be a buy and hold company, it must be able to have an unbreakable moat, meaning to say it must be able to fend off all competition and maintain its market share and defend its market share as well. So how do you know whether or not a company is able to defend its market share? There's a metric that you can look out for, which is your gross margins as well as your net margins. So typically when you want to look for companies with strong moats, you want to look at their margins. You want to make sure that the company is able to hold high margins over time. So if a company is able to hold high margins, or even better, increase its margins over time, it means the company has something called operating leverage. And operating leverage shows that the company is providing a product that is high in demand. So when you want to own your stocks, make sure you check this metric for all your stocks. You want stocks with high margins over time. The next quality for your buy and hold forever stock is you want them to be capital light. So find tollgate businesses that require little to no capital to reinvest into the business, so that all the cash can be given to shareholders instead of putting into reinvestments. Because if you put it into reinvestments, there's a possibility that the money could be burnt. But if you return it to shareholders, it's the safest way for shareholders to get returns over time. So for example, your hyperscalers today, your hyperscalers have extremely high capex, and high capex leads to the risk of the company burning money. And for capital intensive stocks, there's a possibility of the companies not being able to generate a returns on investment or the returns on the capex that they're spending. And that's why you want to avoid capital intensive companies. So this is how you can find capital light companies. So look out for this line in your cash flow statement, which is purchase of property, plant and equipment. You want this metric to be a small percentage of the overall revenue, because low capex means more free cash flow can be given back to shareholders, and there's no risk of the company burning money as well. So the next quality that you want to look out for your buy and hold forever stock is you want them to provide a product that no one else can provide. So this can come in the form of a branded product. So for example, like Coke, or proprietary product that no one else can create, or language that is ingrained in the system. So for example, these are two companies that provide a product that no one else can. So you have Pantone over here. This is a private company. Pantone, what they do is they do color languages. So all your color languages and your codes that you see on Canva, on Adobe, on all your different other platforms, they're provided by Pantone. And on the right over here, it's FICO. So FICO, they provide your credit scores in the US, and there's no other company that is able to basically displace FICO. And so these two companies over here, they're the language in their individual segments already. And when you're the language in your individual segment, you can price your product at any price and people will still have to pay for it. So Pantone is a company that has been increasing their prices aggressively all these years. Same for FICO, which just increased their prices by 40% this year. So next metric to look out for when it comes to your buy and hold forever stocks is you want them to have high revenue growth. So search for companies with secular growth trends like increased credit market, increased digitalization, increased consumer spending, as well as increased birth rate. So for example, a company like Moody's has achieved a compounded annual growth rate of 10% over the past 100 years, which is simply just incredible. So look out for stocks that have high secular tailwinds and high secular growth trends. That is normally the stocks that you want to own. As for how to maintain high revenue growth, there are normally two ways for a company to grow its revenue. So a company can grow its revenue by growing its volume, or a company can grow its revenue by growing its pricing power. Or a company can grow its revenue by growing its pricing on its products. So most companies, they can do the volume growth side, but their earnings will turn sour when there's no pricing growth. So search for companies with pricing power as increased prices all these years without pushback from its consumers. So an example would be Netflix. Netflix has increased its prices on its subscription services over these few years, and yet the subscription has just been growing and growing non-stop. So when it comes to your companies, find companies with pricing power, find companies that are able to increase their prices above the rate of inflation so that they can not only beat inflation, they can also have incremental returns that grow much faster as compared to the revenue growth itself. So the first buy and hold forever stock is Microsoft. So Microsoft has been around for many years already, and the stock price has appreciated quite massively over the past 20 years. So why Microsoft? So Microsoft's revenues are incredibly diversified, and they have achieved a 10% compounded annual growth rate in terms of the revenue over the past 16 years. This company sells software which is capital light, Hardware trends can change, but software is not only cheap, it's also scalable with recurring revenue as well and price increases for Microsoft. So Microsoft is currently capital intensive, but once this cycle is done, this company will continue returning capital back to its shareholders, and I expect them to do so in the future. So this is Microsoft's moat. Microsoft's moat is simply incredible because they're able to fend off competition by bundling everything together and selling it to their consumers. So this is a comment that I saw recently on one of my videos talking about Microsoft. The person said, "You are 100% correct on Zoom and Teams. In my company, we were using Zoom for calls along with Microsoft Outlook for email. Then later, top management decided to go with just Microsoft products and discontinue Zoom for cost saving. Even though we did not like Teams, we had no other choice." So this shows that Microsoft has the ability to fend off competition by bundling everything together. They don't sell the best products, but when it comes to your consumers, they have no other choice. You have to stick with the Microsoft products because Microsoft, they provide the best value for the dollar that the consumer spend. Next two companies will be S&P Global as well as Moody's. These two are your credit rating companies over here. And so why S&P Global and Moody's? So these two companies, they are tollgate businesses. Tollgate businesses means they are incredibly capital light. They have almost zero capex, and what they do is they just sit there and people come to them, pay them money to rate their bonds, and then they keep the revenue by themselves. So Moody's has achieved a 10% revenue growth rate over the past 100 years, which is simply incredible. And I don't think you'll be able to find a company that has such a high track record as compared to Moody's. So they have incredible pricing power as well. So in 2015, their pricing was 6.15 basis point that they charged for the bond that is being rated. And then now in 2022, it is 7.45 basis point for the bond that is being rated. The percentage change might be extremely small, but if you multiply that by the amount of bonds that they rate, it is actually an incredible growth in terms of the pricing itself. So they face no regulation because they price their services as a percentage of the bond itself. They don't have a fixed price, not like FICO. FICO is a company that does consumer rating, and for FICO it's a different story. FICO sells the consumer ratings at a fixed price. So there will be regulation scrutiny over there. But for S&P Global as well as Moody's, they take a cut of the actual bond that is being rated. So there isn't much regulation pushback over here. So they sell an essential product as well. So people that want to sell their debt, they cannot sell it without S&P Global or Moody's ratings, because the S&P Global and the Moody's rating gives the buyers confidence to buy the debt itself. So it saves a company more money to rate their debt than to not rate it. Even if a startup company pays to rate the debt of a certain company, the company will still unlikely choose the startup because the company needs to get it rated from S&P Global and Moody's to get a much lower interest rate or to sell the debt at a much higher price. So S&P Global and Moody's, they save a lot of money for the companies that are raising debt, and that's why they provide an essential product that people need, and I don't see this demand diminishing over the following years. So they have a data portion in their business. So Moody's has Moody's Analytics, S&P Global has Commodity Insights, and all your different other businesses as well. So software and data has zero cost and the revenue is recurring, and it is also scalable. While they don't hold a large market share in the data portion, these portions provide a predictable stream of revenue as well as earnings for Moody's as well as S&P Global over here. So S&P Global and Moody's, they are incredible businesses, and I can see them being around in the next 10, 20, 30 years or so, and that's why they are my buy and hold forever stocks as well. Last two companies that are my buy and hold forever stocks are Visa as well as MasterCard, your network providers. So for Visa and MasterCard, they won't stop growing because consumer won't stop spending. So they grow with the economy, and what they do is they act as toll booths as well on the growth of the economy, like Apple with your App Store as well as your credit rating services. So they can easily grow revenues at 10 to 12% without any risk of reinvestment. So for Visa and MasterCard, they have incredible network effects because the merchants and the consumers are forced to use their products. So if the merchants don't provide Visa and MasterCard payment methods, then they will risk losing the consumers. And when they do that, more consumers will have to use Visa and MasterCard. And it is sort of like a virtuous cycle for Visa and MasterCard. And that's why they've grown to be so big over the past 10 years. And I can see them continually growing over the next 10, 20 years as well, similar to the companies that we discussed earlier. So for Visa and MasterCard, they have two competitors today. They have cryptocurrency as the competitor as well as local payment networks. So local payment networks is a risk for Visa and MasterCard, but they will still have to trade internationally, which will require them to use Visa and MasterCard. So either ways, they have to transfer their money out of their country itself. And for Visa and MasterCard, the international transfer portion is the most profitable business segment of the entire revenue segment. So the other threat is your cryptocurrency. So cryptocurrency will probably never be recognized unless the governments, they switch gold for Bitcoin, And that's why I don't see cryptocurrency as a risk for Visa and MasterCard in the foreseeable future. Of course, things could change and the US government could start backing Bitcoin again. I see that as highly unlikely, and that's why I think Visa and MasterCard, they are highly predictable businesses that will unlikely be disrupted. So they are incredibly capital light as well. They have high gross margins and the only cost is human capital cost. So almost all of that cash is returned to shareholders. And as you can see, Visa has 100% gross margins over here as well. So these two companies, incredibly high margin, incredibly capital light, and that's why I want them in my portfolio today. So there were some notable companies as well that I didn't include in this list. So companies like ASML, Google, Amazon. So ASML is a company that provides your EV machines, but the problem with the business itself is it is incredibly capital intensive and it relies on a technological advantage and a technological lead, which is hard to assess. Amazon is a company that is extremely capital intensive. Google is a company that is too concentrated in your advertising segment. And when an economic downturn comes, Google's advertising segment will definitely be hit. So that is why I didn't include any one of those three companies in this shortlist over here. The companies I have in here are S&P Global, Moody's, Visa, MasterCard, as well as Microsoft. These 5 companies are the one that I can see growing over the next 10, 20, 30 years and beyond. Last portion over here, I'll be answering some of the questions that you guys have left me in the comment section. So the first one over here says, I'm curious about your thoughts on waste management. I feel like this is a very consistent, long performing company with a subscription-like service. They are not a monopoly, but are in a way the areas they serve, and feel they can increase the price when necessary too. Also, like that they are American based with international presence, any feedback is appreciated. So waste management is a very boring business, but boring businesses tend to do very well. So I think waste management has outperformed the S&P 500 over the past 5, 10 years, 20 years or so. And for waste management, the problem that I have with the business is never cheap. So if you have to look at the valuation itself, waste management has never traded below a 25 times earnings. And that is the problem with the business. You will never be able to catch it on a cheap discount. And the only way for you to buy it is to buy it up. So for waste management, I do agree with you. It has a very sustainable and predictable business, and it will likely continue growing all these years because people won't run out of waste to throw. But my problem is I will never be able to catch it on a cheap price. And unless there's a scandal like what they had back in the day, I don't see myself adding to this one anytime soon. Next question, it says, can you please share your thoughts on Brookfield Corp? Thanks. So Brookfield Corp is a company that does asset management. So for Brookfield Corp, the problem that I have with the business is that the business is simply too leveraged. So for your asset managers, there is something that you can look out for, which is your asset to equity ratio. And for Brookfield Corp, I believe the asset to equity ratio is around a 10 times, meaning to say for every $10 of property that they own, they borrow $9 of it and then they own $1 of it. So the $1 is the actual net worth, the $10 is the asset price itself, and then the $9 is being borrowed from someone. So that's the problem with asset managers. They often have very inflated earnings, and the earnings are typically very low quality because they are highly leveraged. So when an economic downturn comes, this is when you see companies like Brookfield being hurt the most because they are highly levered. And for Brookfield, they price their assets at around a 20 times earning. So if you are to dig into the assets that they own and adjust the valuations here and there, you could see this company dropping its book value by around 30% or so. And that's why I'm not investing into asset managers. They're typically bad businesses. And so I prefer the companies that I talked about earlier, which are your capital light and lowly leveraged businesses. I hope you guys have found this one useful and invest safe.